It's still doing it. My iPad looks funny. Oh well, I don't know why it's doing it. I'll have to figure it out. But I will tell you guys, I kind of lied to you. Last week when I said, okay, this week's kind of boring, next week will be better, I kind of lied. This week's kind of still boring. I was thinking ahead, thinking we were already at chapter 4, and we're not. We got a little bit of chapter 2, which is talking about compliance and the IRS and the tax authorities. But hopefully, I got a couple things to talk about that aren't in the book, that hopefully they're real life things, so hopefully it'll make it a little bit better, not just reading from the PowerPoint presentations and talking about the law that's in the book that gets a little blah. So I do actually have some actual audits and a couple cases that happened recently that hopefully you guys have heard about that will make it a little bit more hopefully relevant to what you guys have been hopefully looking at and see how it relates. So just a few of the objectives. The biggest thing here is that I want you guys to get out of this chapter is the different types of audits. That's one of the biggest questions. You'll see some of that on the CPA exam, but you'll also get that question a lot just from people in general. Like what happens if you're doing someone's taxes and they get a letter? Or how do they get a letter? Or how often is someone audited? How often do they get tracked? How do they get picked? We're going to talk about that today. What's the various types of tax law? We don't get into a lot of research. You are going to have a research project. It's not very in-depth. But we'll talk about the different types of research that you can do. And then the different legislative process, we'll talk a little bit about it. And then just as a professional, what are your responsibilities and the penalties that you could incur? That's right. Some of these are pretty, hopefully you know some of these. Oops, go back a little bit. You won't know all of them. So corporations have to file income tax return regardless. It doesn't matter how much money they make, they have to file a tax return. Estates and trusts have to file one if they have over $600 of gross income. So it just depends on what's going on in the estate. A lot of times they don't have to file because their gross income doesn't exceed that amount. And then individuals, it depends on our filing status, our age, and our gross income. That's why a lot of times you'll see where kids aren't filing a tax return because the age does come into play as well. So this is probably one of the biggest questions I get asked by parents is about their kids and when do they have to file a tax return. If they're on their own or if they're in college or what if I do this or what if happens. And so what you're looking at, and this is what we'll start getting into a little bit more next week, is when you're looking at the standard deduction and the personal exemption. So everybody that's single, and that's pretty much unless you're married, we'll talk about the other ones when you have kids, you get $6,300 in 2017. That's your standard deduction. So you get to subtract that off the amount of income that you have. In addition, you get what's called a personal exemption, and this year it's $4,050. So if you add those two together, it's $10,350. That gets subtracted off your gross income. So if you didn't make more than $10,350, you will not pay any tax. So therefore, you don't have to file a tax return. Now, there's different reasons why you'd want to. Does anybody know why you'd want to file a tax return even though you don't have to file a tax return? Huh? You're going to get money back, exactly. So just because you don't have to file doesn't mean that they didn't take taxes out. So if you had taxes taken out of your paycheck and you made less than $10,000 or around $10,000, you might want to file to make sure that you shouldn't be getting money back. So just because you make around that money or a little bit more, a little bit less, doesn't mean you don't want to make sure you don't want to file a return. It just means you don't necessarily have to. The money goes up, obviously, as you go, and we are going to talk all about these amounts. These are amounts I told you are not going to be the right amounts on your 1040s that I handed out. The 1040s that you guys have and that you're going to pull from the internet, if you go back and pull them again, are going to have 2016 numbers. We're going to be using these numbers that are on here. So if you're single and 65 or older or married and 65 and older, you get an additional deduction of $1,550. Right, that's an additional amount that they get no matter what. And then your personal exemption is the same. You have a question?
So what is the difference between standard deduction and personal exemption?
Okay, standard deduction is, okay, it's also going to be on the second page, so it's after your AGI. And standard deduction is what can be replaced by itemized deductions. All right, personal exemption, you get one per every person that's your dependent. So like, I'm married, so my husband and myself, and we have 3 kids that we support. So we're going to get 5 personal exemptions. All right. Then on top of that, we're going to be able, because we're married, we're going to be able to claim $12,600 as a standard deduction. They're saying everybody that's married can deduct $12,600. However, there's also something called itemized deductions, which we'll go through, that could exceed $12,600. And if ours do, which they did, we would then use that instead of standard deduction.
And we can't get the personal exemption?
No, we get both.
Itemized?
No, you don't get the standard deduction if you itemize. You either get itemized or standard. You get one or the other. You always get the personal exemption.
Okay.
Okay? Everybody gets the personal exemption. You get one for every yourself plus every dependent. Okay? And we'll talk about dependency. We go a lot into dependencies a little bit today, but a lot more in chapters 4 and on. And then we go on to married filing a joint return with both spouses, separate return, which we'll talk about because that's not necessarily the best way to go. Head of household is when you're not married but you do have a dependent. Right? It does not have to be a child, but it usually is. But you have to have a dependent. So it could be a parent, or it could be somebody else, a qualifying child or a qualifying relative. And then surviving spouse with a dependent child, or surviving spouse with a 65 or older with a dependent child. So all those amounts are what we're looking at. Now notice the lowest one is married filing a separate return with no kids. And you'll hear me say this over and over and over again. It is not in anyone's best interest 90% of the time to do a married filing separately. Okay, it's just not. Now I say 90% because there's those few exceptions that come in the door, but you lose a lot when you do married filing separately. You lose almost every tax credit that you can get, all the education credits, all the child tax credits, any other of the residential credits or the energy credits. You lose all the credits. And then on top of that, if one of you itemizes, the other one has to itemize. And then if you notice, the gross income drops drastically too. All right, so here they get one exemption. Now you always get your exemption. But the standard deduction, you can't take, like I couldn't take the standard deduction and my husband itemize. If my husband itemizes, I get 0. Or we split the itemized deductions. So it's it's usually not beneficial to itemize. To do married filing separately. The only cases I found where people do it and it works is the one person owes money and the other person usually gets a refund. So they do it married filing separately so that they can get a refund and the other one pays out of their return. All right, so tax return due dates. Okay, we all hopefully know that ours is due on April 15th or the first day, work day following the 15th. Corporations are generally the 15th day of the 4th month following the end of their tax year. Now, I know that's a little wordy, but you got to remember every corporation can have a different end of their tax year. So the 15th day of the 4th month following the end of their tax year. And then the partnerships are the 15th day of the 3rd month following the end of their tax year. And then due dates are, if it's Saturday or Sunday or holiday, they extend to the next business day. And then I think you might know this, but individuals, corporations, and partnerships, you basically get an automatic extension. As long as you apply for it, you are given an extension. It does not give you an extension not to pay. It gives you an extension not to file. So when you send in for April 15th that you don't have your taxes done, if you are getting a refund, they don't care. Because why? Exactly. They're keeping your money for another 5, 6, 7 months, whatever it takes you to file your taxes. They don't really care. If you owe them money, they still don't care if you don't file your paper for another several months. But if you owe them money, interest is going to start accruing. The only thing that filing the extension does is it saves you from paying a penalty. If you don't file an extension, you will pay a penalty. So you want to make sure you file the extension, and then what you should try to do is make a payment, especially if you have an idea of how much you're going to owe. And you can make a payment. If you don't know how much you're going to owe, but you know you're going to owe, put a couple $100s towards it. Do something, all right? And in the state of Missouri, you get an automatic extension just by filing for federal. So you don't have to actually file a state return extension. You get one by filing a federal extension. Okay, so just an example, Corporation XYZ has a tax year which ends August 31st. When are they going to file their tax return? When's it due? what day? I'm sorry. It's December. All right. So the fourth month after, so it's December 15th. Now, if they file an extension, when's it due? How long's the extension for? 6 months. So if we count 6 months out, I'll help you out. It's June. Right? But it stays with the 15th, so it always stays on that time frame. And the funny thing is, if you're ever around in October, you'll always see the same people, even here at the college, running around to get their taxes done. And it cracks me up. I'm like, why don't you just do them in April? Why do you wait to do your taxes? But it's the same people all the time that delay. All right, statute of limitations also comes up. Tax returns incorrect amounts. They want to know how long can they come back to get me. All right, what if you do them wrong? Either in our favor or their favor. And I'm going to talk about in our favor in a minute with an example. All right, so statute of limitations is when we can file a return, hopefully, to get money back in our favor. So we can file amended return. So we have 3 years from the latter of the time of which it was actually filed or the original due date in which it was due. So when did we file the return, whichever one's later. So if you filed your taxes delinquent, you get the latter of when you actually filed them, or when was the tax return actually due. So for an example, Bill and Mercedes filed their 2012 tax on September 6th, 2013. Now it should have been filed on April 15th of 2013, but it was filed on September 6th. They got the extension, which was due on October 15th. When does their statute of limitation end for their 2012 taxes? 2000 when? 15? It's because it was due. It's the latter of when it was filed or when it was due. So is it 15 or is it 16? Something. It's 16. All right, so you got to go from the 13th. And then they actually get to go all the way from the 6th, because they didn't file it till September. So even though it was due April 15th of 2016, they get to go from the latter date of which they actually filed. Because I guess they get the benefit since they didn't file until later. Right, so that's how long they have. Okay, so now how do people get picked for their audits? Now, the IRS used to be a lot different. They used to do a random pick, and it used to be a lot more, from what we were told, it was a lot more targeted. So when I first started doing taxes, I would tell people to absolutely not claim any part of their home. You did not want to claim any part of your home for a home business unless you had a room that was designated as an office that you could claim solely as an office, because that just flagged you right away to be an audit. All right. Whether that was rumor or what, that's what we were told. We were always told that right after we got the CPA, you just did not want to do that. That's not the case anymore, and they don't actually do those random targeted audits like they used to. So basically, they believe an audit, they don't want to look at an audit unless they believe there's a high probability of it being incorrect. They don't want to look at a return just because you filed to do a home deduction. Right? So they're looking at why would you be incorrect. And if you've ever used a software, they actually kind of evaluate you at the end. If you use like a TurboTax or TaxSlayer or TaxCut, at the end of some of those softwares, it will tell you your probability of being audited. And they base it on the number of kids you have, how many credits you have, do you deduct anything in your home, do you depreciate anything, do you have a Schedule C, do you have rental property. The more things you have, they base the higher probability that you could be audited, right? Because the more things you have, the higher probability you did something wrong. It's not necessarily because you had more things. So they use computer programs to identify tax returns that have a liability problem. So it's no longer where they go in and they handpick, because they don't have to. They can use computer programs to help us out. So one of them is called the discriminant function. So the DIF system, this is a scoring system. And that's what they do on these TaxSlayer and TaxCut. They score your return. They figure out, okay, Schedule Cs Having a business is something that's a high score. Rental income, something that's a high score. And also a Schedule K, a partnership flowing onto. Those are high scores. Because those are things where not only a high probability of doing them wrong, but a higher probability of not purposely putting them in the wrong place. I don't want to say you fraudulently because that's not necessarily the right word. But sometimes you do it wrong because you don't know what you're doing. Sometimes you do it wrong because you're putting it in the wrong place because you think you can, if that makes sense. And when you have things like a rental and you have a Schedule K and you have business income, a lot of times things tend to shift around. And the more of those things you have, the higher probability you're going to try to do things like that. And it's not that you're always trying to get away with it as much as that's just how people do things. It's not right. You're not supposed to do it. So that's what the discriminant function, it puts a flag on it. Okay, document perfection, that looks for math errors. All right, math errors are caught very quickly, and it's going to be done with what's called a correspondence audit, which I'm going to show you in just a second. All right, that's very easy to find. It's a very check figure. They come back and they say, guess what? You added wrong, the computer added wrong, or they also can go and they can compare your W-2 with what the numbers you put on your tax return with what your company sent, and you transposed a number, you owe us another $60. And then matching programs where they compare, that's the one I was just saying, where they compare your data to what the IRS said. That's where they can figure out, I remember the first time they did that, and it's been a long time, where, and I felt really stupid, but we filed our tax return right before we got married, really early, so we could get the refund before we went on our honeymoon. And I had switched from what was Southwestern Bell then to Mallinckrodt, and I don't remember what it was, but it was a small amount in one of the 401ks. I had two, I guess, and that one I just cashed in. I didn't roll that one over, and I completely forgot about it. Filed a tax return. We get back from the honeymoon, and I have this letter from the IRS saying that I didn't claim my 1099-R on my tax return, and I'm like, I didn't claim my what 1099-R did I have? And then I open it up, I'm like, oh yeah, that. So I had to amend my tax return, and then I had to pay, obviously, because I had already had a refund. So that's matching program. They go out there and they're like, hey, we got this 1099, and she didn't put it on her tax return. So not putting things on there is not easy to get away with anymore. Computer programs have just pretty much eliminated the ability to do things like that. So 3 types of audits, and then let's get some examples of them. So the first one is a correspondence audit. That's the most common one, and that's where you just get a letter in the mail. Those are common for mistakes like the 1099, like I just told you about, and then also for mathematical errors. If you agree with them, you sign it, you send it back in, you send them a check, or they already sent you a check. If they find an error on their end, the corresponding audit will send you, hey, blah, 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 this is the mistake, here's your check. And yes, I have seen those. It's very happy when you get one. You're kind of like, whoa. And the few people I do taxes for, I've gotten calls sometimes saying, I just got a check for like $280 and I don't know why. What should I do with it? And I'm like, well, what came with it? And they'll send me a copy of the letter. And it was something where they had not included or they had included something on their return that they didn't need to return. And I'm like, well, this is why you got it. And they're like, oh, okay. And they're happy. Or if you do owe money, you just sign it, you send a check back, and you agree with it. If you don't, I'm going to show you what you need to do. The second is an office examination. That's the second most, and it's usually done at the IRS office around you, in which you're going to take copies of your information to them to kind of show them what they are wanting to see. Obviously, that's a little bit more of a hassle, and it's a little bit bigger of an audit. The least common is the field where they are going to come to your business, and that's going to take a very long time. One of my students, in the very first year I was teaching, her husband owned a business, and they were having a combination of an office/field examination. And the reason I say it was a combo is they were having to take everything to the IRS office here in St. Louis, but yet it was lasting months. So it was longer than, it was a much broader scope, but yet they weren't coming to his office, and I think it was because it was a home-based office versus having a business location. So I think that's why they were making them take everything there. And they had grown significantly in size from one year to the next. And that can trigger audits as well. When you have a gigantic change in income, sometimes they kind of they wonder why you had such a gigantic change in income. So that's why. So they took a look at it. So let me show you a couple things here on the whiteboard. So I actually asked, before I'm going to show you this, this was my parents. All right, so I do my mom and dad's tax returns, and we do it here at the VITA program. And so we filed their taxes. Everything went through just like everybody else's taxes did. And my dad gets a letter. And this is what the letter said. I got to flip it back over. And this is Missouri. This is not federal. But it's the same type of correspondence. So after filing your taxes and reviewing it, we made these adjustments. Because of simple mistakes or the absence of documentation, please review the proposed changes. All right, an explanation. If you agree, return with the payment voucher with your payment of $2,325, which about gave them a heart attack, and payment should be made to Missouri. And then if you disagree, send copies of all your information, including, and it goes through and lists that they need their 1099, their W-2, and additional information. And then it went through to say on the second page, explanation of proposed changes, income deduction, payment credits, and they said that they had no qualified health insurance premium, that their taxable pension was changed to zero, that they had no Missouri tax withheld, therefore their amount payment for what they had to owe the $2,300. So I got this, and my dad's like, what happened? And I'm like, you got to be kidding me. So, like I said, we do the taxes here. Every return is filed electronically. So the fact that they are saying they had no documentation was ridiculous because they don't get any documentation. Everything's an e-file. They don't get W-2s. They don't get 1099s. They don't get anybody's 1099s. So the next thing I did was I sent them a letter. Well, my dad sent them a letter, but I typed up a letter and said, okay, you would find a copy of their 2015 Schedule A. And I said, basically, you said you didn't get these things and we're very confused. And I said, we use the IRS software. All information was sent electronically. This is the same process we've used the last several years. And then I said, obviously, trying not to piss somebody off, something got mixed up, so hopefully all this information will be appropriate. See line 8 and line 32. We believe we don't owe this amount and we should get a refund of $2,514 instead of owing $2,500. So a month goes by, and I don't have a copy of this one, and my dad gets another letter that looks almost like this one that says, here's a check for $700. But it's $700. And they're like, here's a check for $700. Thank you. I'm like, they don't owe anything, but here's a check for $700. I'm like, no, it shouldn't be a check for $700. It should be a check for $2,500. So then we do it again. Now, I'm almost ready for a field visit right now because I'm getting irritated, but we're doing this is still all correspondence. So this time, I got out highlighters, and I printed out, and I did it the last time, but I wasn't as specific. So if you can see on this one got much more specific. This is a response, and I gave the notice number, and I started being very specific. And I said, line number, line matter, Medicare was not included. I've highlighted it. This is STRS, which is a public Ohio public pension, which I was thinking, well, maybe that's why they're missing it, because it's an Ohio public pension, not a Missouri public pension. And then I said these adjustments were needed. They feed to this page, which flows over to this page, which then flows to this page, which means you owe them money. They got it on Thursday, last week. They finally got a check for the remaining amount of money. So they filed at the beginning of March. Maybe even February, because they're one of the first people I usually get through. VITA students do it. I usually give it to them as like a test because it's harder return with Medicare, and Ohio pension and stuff. They just got it figured out. So that's a correspondence audit. So some of them can be easy, like I said, you owe us $70 or here's a refund, and some of them can be that. Now imagine that if you're not an accounting person, or if you're not a tax person, and they send you a letter saying you owe $2,500, and you're like, no, I don't. You send them a letter back, and they give you $700, and you're trying to explain. Because that alone right there, I mean, that took me a couple hours to be that specific. I printed out all the forms. I highlighted it on the form. I then linked it to the next form, which linked it to the next form, and printed it all out because I was not doing this again. And then, lucky me, I went back and looked at their 2014, and somehow they did not get the it was my fault. I did not give them the pension exemption, so I have to amend their 2014 return. So I might get to do this again. So that's a corresponding audit. That is the most common, and you can get that same letter. I don't have an example of the same letter, but the same format from federal, the same exact thing from federal. And I didn't print out the line by line because it has their actual income and everything on it, but the line by line will show you on the left side, here's what you gave us. On the right side, here's what we should have. And that way it's easy to find. And that's how I knew when I was saying line 1, line 2, line 3, I'd be like, nope, line 1's wrong. It should be this amount. So that's their wonderful little correspondence audit. One more. There we go. Okay. All right, there's a few slides like this, not going to spend a lot of time, but there are, even once you go through all those wonderful audits and you don't believe you're wrong, there are an appeals process. You don't have to just say you have to owe the money and you're done. But there are different, and there's different ways to go through it. We're not going to kind of follow the whole flow chart, but basically you got 30, 60, 90 day. You got different courts you can go through to follow the appeals process. So just because you go through it, you go through the audit, they say you're going to have to pay all, it does not mean that you absolutely are done. There is a court process, an appeals process that you can go through litigation. Why is it not going? Okay. We got a couple different tax court. We got the tax court, the U.S. tax court, and then we got the federal claims court. The U.S. district court is a local possible jury, depending on what's going on. The national court is the appeals for the federal circuit court. And then this is the federal judicial court. Again, this is what feeds up to the Supreme Court. And then, in case you ever wondered how the Circuit Court of Appeals looks like, this is what it looks like. It's based on districts, and so you can kind of see how they're numbered, and then this is all based on population, obviously, and then the Circuit Court, we're in Circuit Court 8. Outside of that, I really don't know what that means for us, but we're in Circuit Court of Appeals, District 8. Okay, so let me go out of here real quick, because I want to just kind of, so you kind of know a few other things. It's not always, I was going to print this and I could not, I could not print it. So, do you guys remember this guy? He was the very first winner of Survivor. Now, Survivor's been on something like 20 years. I did not even realize that. I didn't watch it. But this guy was the very first winner of Survivor, and this is how you might remember him. He was the guy that walked around naked on the show all the time. Oh, why is that not there? Where did it go? You know, this is what it did in my... Marcus did something. Hang on. Yeah. me pause this guy.